Welcome back to the Reverse Mortgage Dilemma podcast, episode number 3, the show that discusses, strategies and insights for navigating reverse mortgages. In today's episode, we'll share information that could help you make more informed decisions about your financial future. I'm your host, William, and joining me is my co-host, Sophia.
It's great to be here, William. Today, we're tackling a big question we hear all the time. Homeowners see conventional mortgage rates in the news, and then they get a quote for a reverse mortgage and experience, some sticker shock.
Exactly. So let's set the question clearly. Are reverse mortgage interest rates too high compared with, say, FHA forward and conventional mortgages? Or are they priced for different risks and features?
That's the perfect way to frame it. For context, as we record this in mid-August 2025, a typical 30-year fixed conventional mortgage is in the mid-6% range?
Okay.
But then you might see a reverse mortgage quote with an annual percentage rate, or APR, that's over 9%.
Wow.
It's only natural to ask, why there's such a big gap.
It is. To understand it, we first need to look at how the rates are constructed.
Right.
For the most common type, the FHA-insured home equity conversion mortgage, the HECM, an adjustable rate is made of two parts, a market index, like the SOFR or CMT, plus the lender's margin. And that margin is fixed for the life of the loan.
But the real key to that higher APR is what gets bundled in, isn't it?
Yes.
It's not just an apples-to-apples interest comparison. A HECM's APR calculation must, by law, include ongoing costs that a conventional loan doesn't have.
Right.
Most notably, the FHA's annual mortgage insurance premium.
That's the core of the issue. That annual MIP, it costs 0.5% of the outstanding loan balance each year.
Wow.
It's the fee a borrower pays for one of the most powerful benefits of a HECM, the FHA's non-recourse guarantee.
Okay.
And this protection ensures you or your heirs will never owe more than the home's value at the time of sale.
And that's a crucial protection you simply don't get with a traditional mortgage.
Exactly.
It's insurance against a major housing market downturn. But the biggest difference and the biggest driver of risk for the lender is the payment structure itself. With a forward mortgage, you start paying the bank back immediately.
Yeah.
But with a reverse mortgage, the lender might not receive payback for 20 or even 30 years.
Precisely. Because there are no required monthly payments, the interest just accrues over time.
Right.
The lender has to carry that cost and risk for decades.
Wow.
So that deferred cash flow, that extended risk profile, it has to be priced into the rate. A forward loan is designed to be paid down. A reverse mortgage is designed to be paid back in a single lump sum far in the future. They are fundamentally different instruments.
Okay, so that explains why HECMs are structured differently. But William, let's go a level deeper.
Sure.
What about the proprietary or the jumbo reverse mortgages?
Yeah.
Their rates are often even higher than a HECM. What's the reason there?
It comes down to risk again, just a different type. Jumbo loans are not insured by the FHA.
Okay.
The private lender takes on 100% of the risk.
All of it.
If the loan balance eventually grows to exceed the home's value, the lender, not an insurance fund, bears that loss. So to compensate for taking on that full risk, they charge a higher interest rate, typically a point or two above a comparable HECM.
So you're paying a premium for the lender to self-insure the loan, but what does the borrower get in return for that higher rate?
Yeah.
This is where it gets really important for people with high-value homes.
It is.
The FHA-insured HECM is a wonderful program, but it has a lending limit.
Right.
For 2025, the FHA will only insure a loan based on a maximum home value of $1,209,750.
Okay.
But if your home is appraised at $2 million, you can still only borrow against that $1.2 million figure.
But a jumbo loan blows past that FHA cap.
It does.
It can lend on the full appraised value, often up to $4 million or even more. So let's say you have a $2 million home and you need to pay off a $1.3 million existing mortgage to retire. An HECM simply can't provide enough funds to do that. A jumbo loan can.
Wow.
That is the textbook case where a higher jumbo rate makes perfect financial sense.
Right.
The jumbo loan is the tool that unlocks the equity needed to achieve the primary goal. In this case, eliminating a huge mortgage payment.
Wow.
The higher rate is simply the cost of accessing that otherwise unavailable equity.
So to bring this all home for our listeners, the decision-making process becomes clearer.
Yeah.
It's about matching the right tool to your specific situation.
Exactly. If your home value is comfortably under the HECM cap, its FHA protections and structure are likely optimal. But if your home's value is well above that cap and you need more money than an HECM can provide, the jumbo becomes the logical choice.
That's the most logical way to approach it.
Yeah.
And regardless of the path, it is absolutely critical to shop around. Compare fully itemized loan estimates from several lenders.
Okay.
Scrutinize the interest rate, the lender's margin on an adjustable rate loan, and the total closing cost and fees.
Which brings us to a quick myth check. We often hear the blanket statement, reverse mortgage rates are always outrageous.
Yeah.
From our discussion, it seems the more accurate view is that they're structured for different risks and, built-in benefits. The rate you see isn't just for the money.
Right.
It's for a package that includes the benefit of no monthly payments, non-recourse protection, and FHA insurance.
Okay.
The right question isn't if the rate is high, but whether the total cost is a fair exchange for the cash flow relief and stability it can provide for your retirement.
So to bring all of this home for our listeners, the decision-making process becomes clearer.
Yeah.
It's about matching the right tool to your specific situation.
Exactly. If your home value is comfortably under the HECM cap, its FHA protections and structure are likely optimal. But if your home's value is well above that cap and you need more money than an HECM can provide, the jumbo becomes the logical choice.
So ask yourself, is cash flow relief and flexibility worth a somewhat higher rate if it helps you stay in your home comfortably? And if your home is well above the HECM limit, would accessing more equity at a jumbo rate actually reduce your overall stress and obligations? As we wrap up today's episode, remember to join us each week for the latest reverse mortgage news and hot topics that matter most to you.
Right now, we're giving away 250 free digital copies of The Reverse Mortgage Dilemma.
Wow.
Just visit reversemortgagedilemma.com, click Claim My Free Book, answer a couple of quick questions, and your downloadable copy will be on its way.
Prefer the paperback or audiobook? You can grab those on Amazon or simply click the link in the episode description.
If you enjoyed this short, targeted mini podcast, hit that subscribe button so you never miss an update.
Yeah.
Got a question you'd like answered on the show? Drop it in the comments. We read every one.
Thanks for tuning in. Until next time, take care and we'll talk soon.